gentlemen, so tonight, let's start morning. Okay, tonight we were talking about calendars. Calendars is an interesting form of option trading, but it's not a main core options. That means that you do not use it on a regular basis. So what is a calendar? Calendar is very simple. Now let's say you buy 14 options. And you got August, one options, we got August, 14 options. So, what is a calendar? A calendar is very simply this. The calendar is simply this. Same strike price, different expiry. For the question, we say here is 100 call. 105 here, 95 here. So what is a diagonal? What is a calendar? Calendar very simple this. When we always buy a diagonal. We don't sell a diagonal. Okay?
Diagonal or calendar?
Right, a calendar. Whenever we always buy a calendar. We do not sell a calendar. That means that wherever we do, we must pay money for the calendar. If you collect money for a calendar, then you are actually in for an interesting time. Let me explain to you how it works calendar. Simple. Let's say you are selling a 100 call. You sell 100 call in June, and you hedge by buying August. So this is called a diagonal. It means that you short 100 call in July, and you sell your hedging rate is August 100 call. This is what we call a diagonal.
No, calendar.
Sorry. I'm getting old, I'm very tired also. It's just you look very tired, I am very tired. Come. So, long, short, 100, long 100, short July, long August, September, December. So basically, we sell short term, we long term. This method is most of the time it works for nice trending market of limited move. It's excellent for slowly moving up market or slowly going down market. We buy for one reason. See, end of the day, it's simple this. So Thomas, in this year, so how much can you save a lot of money? So what's the difference? Here is they say here is $3 time premium. And here, August is $5 time premium. So what you do is, instead of buying an August call, 100 call for $5, you buy a calendar, you end up paying only $2. Sorry, $2. Why $2? Your long leg, $5, correct? Your short 100 call July is $3. Okay? So this is a perfectly good trade. If your assessment, the market move, do not move too far. If slow and steady trade is excellent. If this trade, if you expect this one to hook all the way up then please do not do this trade. Okay? If you expect for big violent move, calendars is not it's not a good method.
So it's a range bound.
It's actually what you do. You want the market to slowly start with 90, 95, slowly when slowly here 90, 99 here, expired worthless. You see expired worthless. But this is a debit trade. So how much can I lose the worst case? Thomas, if I buy a calendar, what happens? The thing shoot up totally up to $120. How much money I make? You do not make money. Why? If the thing shoot up too fast, $120. Let's say it shoot up $120. Let's say it shoot on the 10th of July. The thing got to 120. How much money can you make? None. Why? Because your July options not expired yet. Still got time value, still in your short rate is still here. So Thomas, my long rate I make $20. Agreed. But your short rate also lose $20. Okay? Then I still make money because of time premium. Not true. Your time premium already you paid if you pay $2 for time premium. So if both legs are $20 in the money, what happened to time premium? Contracted. So will you still get $2 out of it? I love it. Maybe get 50 cents. So if you move too fast, too big, you lose money. This trade is excellent for slow and steady. So when is the good time for this trade to go up? This is an excellent trade. This trade is excellent for one more thing. It's good for what we call what we call long-term enhancing action trade. What means basically what enhancing action about? Let's say the market now is 93, 95. Come third week, July is $99. Let's say $99. What happened to this option here? Expire worthless. Now underline 99, correct? Okay? Can you not, since this trade 99 here, can you not sell August the first option, sell the 105 option here, sell here? Cannot. Okay? So market got higher. Now go to 106. Thomas, I lose money. Excuse me. If here lose $1, here how much you make? So this is what called rolling over action. The rollover action, as Mr. quite explained before, at slightly different level, it's exactly the same. Exactly the same as your double diagonals in the past. The diagonal past. So you roll over. And this method can make, if you're right, can make 500,000%, 2,000% easily. Why? As the market go higher, Thomas, can you not sell 110? Can. Go higher, can you sell 120, 115? Thomas, here lose money, here lose $1, $2. Why worry? Because your hedging rate is 100 there. It's over 100 here there. So here you lose money, here is make money. Remember, at 110, 15, your 100 call, which I bought for $2, is worth $15. And not only that, every time you sell your short leg here in July, August the 1st, August the 2nd, here selling, when you sell at time, what do you receive? Premium. So you receive 3 times premiums plus $15 physical valuation. Is that not a lot of money? How much start out first? You start with $2. $2. So this is what we call a calendar. A calendar most of the time is best work in what we call rolling on trade style. Questions?
Yes.
Very confusing.
Yes.
Of course confusing.
No. When you sell in August 1st, what strike price is selling? Why do you choose that 105?
Because 105
It's in the
How
money.
much you share for example?
okay, wait. The example is not 105 because underlying is 99 or 101. So you sell the next out the money strike, the money strike crack, or out the money strike crack, you bet 105.
Okay, so it's add the money.
Add the money or out of the money. Okay? Okay?
The next one.
Next one. So let's example we do charge here. We don't care. Let's say you got 100 call here. This is the plus leg here. Okay? You started with minus 100 call here. Let's say this is July 1st. Okay? July 2nd. July itself. July 4th. This leg here is September. Okay? We started off with short 100 call here in July, the first week expiry. We long September 100 call. For discussion purpose, we put the fact it will cost you a grand total of $2. It's quite reasonable. This is not a very cheap trade. This $2 should be technically, depends on volatility, should be quite fair value. Quite fair value, okay? So, the market started with maybe 96 here. Okay? come expiry, go to 99. Okay? When expired, what happened to the trade? This is 99 on the first Friday of July. What happened to your 100 call here?
Try worthless.
Worthless. So you come worthless, right? So you come like that, cancel off.
Wait, Thomas,
Hmm?
you sell a call.
Sell a call, sell 100 call here, buy 100 call here. Different time frame. Okay? Let me run through example then ask questions later. So now, you see now the market price is what? 99, right? So you want to buy 100? Not very good idea lah. After you try to sell for 1 week, 100 is a bit too near, right? So what do? You sell 105.
July 2nd or
July 2nd. Correct, maybe $1 plus. Okay? Let's say correct, okay lah, say around $1.50 lah. Okay? Then the market is still, your adjustment is right, the market continue to go up. Okay? Come second Friday of July, wow, the market go too high. It go to 106. Thomas, I lose money. Stop. First, you never lose money. You collect 150 in the first place. Secondly, more importantly, here, okay, here is at 105. If you hit 106, what happened to your 100 long call here?
$6.
It makes $6 already leh. The best part, you already collect 150 here leh. So that here 106 now. Okay? Then you said, don't mind, I will take now a net 50 cents, so I plus net 50 cents because I have to pay back $1. Then now for July itself, we sell maybe, okay, no, I sell 115.
Too fast.
Slowly much. Then I run through example, then we ask questions later. We sell 115, right? The market go higher, and you say go to 110. Never go too high. But you collect $1 for it also. Let's not collect $1. You go to 110. Your short is 115, expire worthless, right? Can you not sell maybe 115 again one time? You see now? Thomas, what happen if my short become in the money? Why worry? Your hedging rate is 100 now. So for every dollar you lose on your short side, indeed because you reach 150 now, it's hedged by 100% hedged by your this here. Your mother share here, your long hedge here. Okay? So this roll over, it can roll over 4, 5, 6 times, right? I lost count, but I ever roll over quite a number of times.
3 months, usually 3 months maximum.
The duration of trade, last time I do up to 1 year. Well, depends.
What is the ideal? What should be the?
No, it's not ideal. I explained just now to you about the double top, double bottom, double top discussion. What is the time frame of your assessment of your bullish move? If the bullish move is 3 months, a 2 month bullish move, then you go buy a 3 months options.
No fixed rule.
No fixed rule. It's on duration, on the duration. If your assessment is this move is going to be good for 6 months, please go buy 9 months options, 1 year options. Because why? You say I budget move is 9 months. Okay? The best part is that between the 9 months option, there's no much subject obvious for 9 months options is much more expensive. The option is not expensive as it is because the time premium between months is quite limited. Because it's same strike, short 100, long 100. So what's the difference between no volatility inside? Because both are 100, correct? What's the volatility left is left only the cost of 100 days one, the 100 days options cost more time premium than the 10 days option. What's the difference is what you pay. Afterwards we use some we go through real life examples. So these are excellent. So as you know, roll over. So what Thomas here you trip to 220, you lose money here. Why worry? Your hedging rate is 100. It's guaranteed you make money already. It's a problem is how much you make. Because that one will do to how much strikes you work in favor. This method I showed you just now is excellent for a nice trading market. Okay? Trading market is good.
Gradual trending.
If you aim for one what we call yo-yo bunky jumping market, this method don't work. Slow, steady trading up market, excellent.
What about the price go the other way around?
If the price go the other way down, Here expired worthless. How much you pay the first paper trade? $2. You see and sell, you will not lose the $2. That depends how extreme the price move is.
You mean the price go down this way, it's not as good as it go up, right?
No, depends if you call or puts. Now we're talking about call position.
Call.
Remember, when you do this trade, when you do a call calendar, buy a calendar, you are technically doing a bad bullish trade.
Oh, okay.
Okay, you can actually, technically speaking, you can do both sides.
No difference, either call.
No, you can do a straddle in. Sell, do a put one, do a call one, do a call, do a put inside bracket in, whichever side start with making one trade direction close on top, take a small loss then you go downstairs. The maximum loss for this trade exclude, okay, you can face at the initial phase is the debit you pay to open the position. It's fixed defined risk. That's a good thing. The good thing you also can run through multiple trades. So all the good things So what's the bad thing? Like Tina said, hey Thomas, very confusing. And yes, and the worst thing is this, for beginners you need to do rollover action. As Mr. Quack was explaining to you, not that easy it's said easy but doing it not so easy. So this one is good if you're an experienced trader or you got me around to handle session. A calendar is excellent for training trades. Whether call, by the way, you can do both sides. You can do call side and put side concurrently. If you have the risk budget. Questions? Ina?
Very confusing.
I didn't want to ask, not following, totally lost.
Okay. Anyway, let's say I think the next week diagonals will be postponed to future day until we settle down with live trading first.
Some example maybe easier to understand.
I'll explain some sample trades. Okay. So understand the principle. The principle of trade is that for a calendar, buy 100 call, sell.
Thomas, I recommend a stock. eBay.
Okay, one more first. Maybe I know you come here for hot tips and structure. For a calendar, 100 call, buy short term, sell short term, buy long term. In a way, it's like a vertical spread. But instead of vertical spreads having different strike price same month, this is same strike price, different time frame. Okay? Questions? If not questions, let's go down to eBay. Let's see whether can make money from eBay.
You look at 5 years. 5 years.
Don't be too far. If 5 years, then my trade is going to be 6 months at least.
Okay, 1 year.